Saturday, June 17th, 2023, Monaco 64, home of alternative economics and contrarian views. First of all, I'd like to wish you all a very good weekend, and I hope you're all doing very well. The weather here in England is quite nice. It's cooled down a little bit, but I think it's going to get warmer later on. And today I want to talk about the UK debt time bomb. I have a playlist about the topic, which you can look into on my YouTube channel. And I think it's detonating as we speak. And households are going to be hurt the most, I think. Small businesses as well, small and medium-sized businesses. The government will get hurt, but the government can always do things that we can't do. They can get the Bank of England to print money for them, and they can borrow at very, very low rates, albeit right now rates are going up, but they can always find an excuse. And what I want to focus on today is the blame game or the scapegoat. And I think we need to be very careful who we believe for the troubles that our economy is in right now, with the rising cost of living, which is the consequence of inflation. And that's what I want to focus on. And before I look into inflation and the rising cost of living and the scapegoat mentality, I want to read this quote from Felix Sommeray, aka the Raven of Zurich. And I'm going to put a link to his biography or memoirs in the description of this video. And this is what he said. The state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible. So what he means here is that, yes, only government can create inflation because only government has access to the printing press and to the central bank. You and I cannot go to the Bank of England and just ask Andrew Bailey to print £1 million for us. The government can, and that's what inflation is all about. And what does it do? It's very simple. It dilutes the milk. So let's say it was the Bank of England, they used milk as money. So the government just asked them to create more milk, and they didn't have enough milk, so they just put water in it. So that's what they do. The money should be gold and silver, but they're just putting paper into it, and it's diluting the value of the money. So that's what inflation is.
With rising inflation, bank failures, and massive layoffs across multiple sectors, the future of the economy remains uncertain. It's no wonder the central banks have been getting prepared by stockpiling gold. At ITM Trading, we have spent over 27 years building a team of seasoned researchers and analysts who can help you prepare for any financial crisis. Our experts are ready to provide you with proven strategies to safeguard your wealth and assets in the event of an economic downturn or currency reset, which is frankly inevitable. Don't wait until it's too late. Schedule your free gold and silver strategy call by clicking on the link in the description below.
And a lot of you probably know, my old viewers and subscribers, that I warned back in 2016 that Brexit was going to be used as a scapegoat for a deliberate inflationary policy. And why deliberate? Why would the government inflate deliberately? Well, because the government is the biggest debtor out there, and they've got this capacity to create the currency out of thin air. It dilutes it. It makes their debt worth less. So what happened in 2008 and 9? Well, the UK government had to bail out the bankers in the City of London and Wall Street. And how do they do that? Well, it issued hundreds of billions in debt, guaranteed these failed banks, took over some of the failed banks, and the Bank of England obliged by printing money. That's what QE was all about. I think they did about 435 billion. That was up until 2020, and that's what inflation is. And we're paying now for the debasement of the currency, all the years of money printing and really negative real interest rates, as you can see here by this chart that I made. And I've used the RPI, the retail price index, because it's a much better reflection of the rising cost of living for the average household. And as you can see, prior to 2008 and 9, the Bank of England rate was almost always a few percentage points above the RPI. So that kept prices in check. That kept inflation under control. And by inflation, I mean the creation of currency and credit out of thin air, not just by the central bank, but also the private commercial banking system. But as you can see, the system collapsed in 0809. And since then, they've kept the base rate way below the RPI. And it's been happening, well, for 14 years now. We're in 2023. This started in 2008 and 9, maybe even 15 years now. And even with a Bank of England rate at 4.5, which a lot of people think is really high, we might go to 5 and top at 5.5. Well, we've got RPI at 11.4. That was the latest number. So the real rate is still very negative. So they're continuing to inflate. And that's why we're seeing a rising cost of living. The pound doesn't go as far. They call that inflation, but the inflation has already happened. The horses have bolted already from the barn. And what we're getting now is the consequence. And that's why I always think that it's very important to stick or know the real definition of inflation, and not to call CPI or RPI inflation, but the consequence thereof. So back to scapegoats. Well, I'm not surprised. Here's Mark Carney. He's a former Goldman Sachs alumnus. He's also a former governor of the Bank of Canada. And he's also a former governor of the Bank of England from July 1st, 2013 to March 15th, 2020. And that date is very important. So Mark Carney, who's also an Uber WEF member, very much into this climate agenda, he's come out and he's blaming Brexit for inflation, claims Mark Carney, former Bank of England governor, says the biggest shocks in decades could take years to unwind. And he's actually saying that he warned that Brexit would cause economic problems. That's fine. But I think it's got a lot more to do with the creation of money and credit that we've seen. And what we're getting now is the consequence of years of inflation from people like Mervyn King, Mark Carney, and now Andrew Bailey. It's not because of Brexit. We've had high inflation in all other countries. Yes, here it's been a bit higher, but why do I think it's higher here? Well, because the pound is not as an important reserve currency as the dollar or even the euro. So the Bank of England thought in March 2020, and he kicked off this policy of they cut rates from 50 basis points to 25 in March of 2020. That was under him. They announced more QE. That was under him. And Andrew Bailey just took the baton and continued the policy. And we went from 435 billion in QE to almost 900 billion total assets by the end of 2021. So they doubled the balance sheet, more than doubled the balance sheet. They cut rates eventually to 0.1. That was under Bailey, but it was Mark Carney who kicked it off. So for him to blame Brexit for inflation is dishonest, and it's just trying to fool people. It's to try to detract the attention from the real problem, which is this central banking fiat money currency system, whereby us, the taxpayer, the general public, get burned both ways. When the banks make huge profits, they keep those profits. When the banks collapse like they did in 08, 09, they keep they don't make profits, but they still get their bonuses, the bankers. They're bailed out by us, and they stay in business. And we get lumbered with all the debt, with a depreciating currency, which is basically the consequence of inflation. So, so just wanted to show you here some charts. You can see that Mark Carney, he cut rates in 2016 after the referendum from 0.5% to 25. He tried to raise it back in 2018. He didn't even raise it back to 1%. It was at 0.75. And then he started cutting just before the lockdowns. And then they announced more QE. And that, my friends, is why we have rising prices, or what they erroneously call inflation. We've had the inflation already. So now we're told that the Bank of England is hawkish. It's raising rates. But as you can see, RPI and even CPI is way above the base rate. And we're also been told that, they're unwinding the balance sheet or doing quantitative tightening. But I've looked at the Bank of England numbers. And yes, the amount of assets they had under their asset purchase program, the top was 894,947,000,000. That was in December of 2021. Do you know how much it's dropped since then? And that's like 18 months. Well, it's only dropped 7.9%, and we're still at 823,792,000,000 as per the latest data. And prior to 2020, the balance sheet was around 445 billion. So it's still 85% bigger than it was pre-COVID. And it's, I think, almost 100% bigger than it was pre-2016. So a lot of that happened under Mark Carney, and he kicked off the rate cuts in 2020 and also the QE. But the policy of inflation, as I said, is one that is deliberate, because it makes it easier for the government to stay in power, or the state, really. It doesn't matter if it's conservatives or labor. This would have happened under labor. I'm not slagging off any parties here. It doesn't really matter. They play for the same team. They play for the people who control the currency, the bankers. And and we're paying for this. A lot of people's mortgages and house values were saved back in 08, 09, but we're now paying for the consequence of that. And we're also paying for the largesse of 2020, 2021, where mortgage rates got to really low rates. And now that the consequence of inflation has kicked in, we're going to get a debt problem. We're going to get a mortgage problem. And I think that will be the biggest crisis, and it will be more for households. And this is out today here in the I newspaper. UK mortgage rate crunch is bigger than the 80s or 90s, say experts. The average person remortgaging will see their repayments rise by 2,900 a year, according to Resolution Foundation. That's about £241 extra a month, and that's just the average person with an average mortgage. So I spoke about this a couple of days ago. They're even calling it a mortgage time bomb. So they're using the language that I've been using and warning about for years, and it's coming home to roost. And hopefully, a lot of you who have been following me have tried to pay off a lot of your debts and mortgages. In the past, a lot of people asked, well, if they're going to keep inflating, though, it's going to write off the debt. Well, that's true. But if you leverage yourself too much, if you take on too much of a mortgage, too big of a mortgage, and like people did in 2020, 21, and they encourage people to do that, then when rates start going up, it's a nightmare. Unless you have a really good job, a safe job that's paying well, and then you'll be okay. But yeah, it's going to be a rough road ahead for everyone. And yes, they're going to blame everything else but the government and the Bank of England. And I guess the general public is to blame to some extent, because they would have been unhappy if they had let everything collapse in 08, 09. There would have been probably riots in the streets. So that's why they had to keep pumping the system with fiat currency. And they did the same in 2020, 21. I think people would have been really outraged because they were told to stay at home for 240 days. So that they had to have a quid pro quo, and that's what it's all about. In the end of the day, that's what inflation is all about. It's not because of Brexit. So we're going to continue to see, unfortunately, a lot of mortgage defaults. We're going to see prices drop quite a bit, house prices, and I think rates haven't gone up as much as in the early 90s, like to 12%. But I think they could actually, even though a lot of the mainstream analysts think it's going to top maybe later this year and next year. Unfortunately, I think it's going to get worse. And the fact that they cut rates almost down to zero, even mortgage rates, allowed many people to borrow a lot. Their mortgages got a lot bigger in terms of amount than it was 25 years ago. So even a rise in rates to, let's say, 8% could be worse than a rise in rates that we had in the 90s to 12%. So if you don't have a debt or mortgage problem and you've got a lot of savings, you might be asking, what do I do with my savings? Do I put it in a deposit? After all, interest rates are rising. Yeah, maybe you could do that, some of it, but I also think it's still very good time to keep stacking gold and silver. And why do I always talk about gold and silver? Well, because they're real money and they can't be created out of thin air willy-nilly like the central bankers do with fiat currency. So they hold their value over time. Yes, their prices in fiat currency fluctuate over time, but if you go back to the 70s, 1 ounce of gold was like 17 pounds, and now we're in the almost up to 1600. We've come off a little bit, and I think that's going to continue because it's going to be the only way that they can pay off the debt, the government. And unfortunately, households are going to get hurt, and probably BlackRock and a lot of the private equity groups, they're going to swoop in and buy a lot of homes. And it's all part of this program, I guess, of the globalists that want you to own nothing and be happy. So that's where I'll stop here. Tomorrow, I'm not sure I'll be doing a live stream because we're going out for a barbecue to a friend's house. It's Father's Day. Rudy's going to go as well. Our friend has a couple of dogs. I think he's going to have a good time with them. And so, yeah, I wish you all a great rest of the weekend again. And take care. Bye.